Hi, and welcome back to Tea Talks on OnLadder. My name is Cameron Orca, and I'm the CEO and co-founder of OnLadder. As part of our interview series, we talk to industry leaders from the mortgage and housing industries to talk about the big issues of the day. Today, we're talking to Robert Sinclair of AMI, the Association of Mortgage Intermediaries, to talk about recent events in the mortgage market over the past 4 weeks and where things go from here. So yeah, with that, thank you for being here, Robert.
Good to see you, Cameron.
Good to see you as well. So I guess let's just to start things off. Do you mind introducing yourself?
Okay. So I'm Robert Sinclair, the Chief Executive of the Association of Mortgage Intermediaries. So I represent all the mortgage brokers in the UK to regulators, to government, and to anybody else who's prepared to listen to us. Often lenders, because we have to have direct conversations with them sometimes about how the market's operating.
Yeah, it's great to have you on, and really at such a it's really timely to have you here, just because there's been so much going on in the market. I mean, I certainly have whiplash. I don't really know about you. I guess for you, like, how do you see things playing out in the current environment, especially over, say, the next 6 to 12 months?
I think there's going to be a series of process developments or policy developments over the next few months that will try to keep us out of choppy waters. And I think that's the challenge that faces government as much as anybody, and the central bank and the potential regulators. That's their challenge, is how do they try to keep things on an even keel, given where we got to in the last 6 weeks or so. That fiscal event clearly spooked the markets. It caused interest rates, caused gilts and swap rates to escalate. But of course, the Bank of England has really yet to react to all of that. And that'll be interesting to see how that plays out. So clearly, the event where the Chancellor is due to speak to Parliament on the 31st of October, which may or not be Fright Night, we will see, will clearly give a clarity as to where government policy is going to go. And although I think it looks fairly clear now around that. But what that does is then will allow the Bank of England to give a clear indication of where they think base rate trajectory is. Clearly, the swap and gilt markets have come off the top and are gradually coming back to what I think most commentators would view as a more sensible space that's more aligned with global markets. We've got a situation where we did have a base rate trajectory which was looking north of 6%. Mm-hmm. Most people are beginning to talk about that being closer to 5%. My view is we might not get back above 4.5% if the inflation shocks that are in the system, caused by effectively oil, gas, and the linked costs of petrol and things like that, and also the dislocation in supply chains caused by the regular shutdowns of COVID still happening in China. All of these things are putting cost pressures into the economy. If those feed out and we don't have anything else that increases costs, then inflation runs out naturally back to a more normal level by the middle into Q3 next year. And that therefore means that intervention by higher base rates comes off as well. And therefore, the hiatus will be for the next 12 months. But it will be a gradual up and down in terms of us seeing things evolve and having to react quite quickly to that, if that makes sense.
No, it's good to hear that the base rate's not going to be above 6%.
Well, there's no guarantee of that, but in the world that I look at the moment, I don't think it goes there.
Yeah, it's a frightening thought. But even if it doesn't get that high, you're still going to have issues.
Oh.
And definitely for first-time buyers, especially for mortgagors, coming off of their current fixed-rate deal, which is quite a bit lower than what they're about to see. So I guess, how do you see things working out for these two target markets?
I think you have to look at it in two ways. First of all, the vast majority of people coming off a fixed-rate deal will have a rate that's starting with a 2. Mm-hmm. Some people may have a rate that starts with a 1, and some very lucky people might have one that starts at less than 1. But 2 was kind of the bottom of the market until we got to, I would view, silly money, which was a beneficial point that really meant that house prices defied gravity. And that's what caused the last 10% of house price inflation was those very low rates, which meant that house prices defied gravity in terms of the economic gravity that should have been sitting around that. People, therefore, in the largest cases, hopefully we're coming off a 2% to a 4% rate. Now, what we have to remember is that most of those customers were stressed by their bank, their lender, at 6%.
Right.
Now, those banks are very strongly capitalised, have high levels of liquidity, have the capacity to look after their existing customers probably more than people think in terms of the price they might have to pay to bring new stuff onto the books. And therefore, what I think we might see, and we're going to see a little bit evidence of this already perhaps, banks offering cheaper rates to their existing customers to stay with them than they might have out there to bring people new into the market. Now, as you've rightly just alluded to in the question, The hardship might be in the people looking to buy and get mortgage from somebody else, or first-time buyers in particular who will have particular difficulties when that rate is at that 5-6% level rather than the 2-3 that we were looking at in the past, because that does add significantly to their costs. But of course, it isn't just those costs that are escalating. Utility costs are increasing, their food costs are increasing, and if their mortgage cost goes up or if their rental cost goes up, that will put them under financial pressure.
Yeah.
And then people are facing into some interesting decisions, or pretty grim decisions, around what do they do with their discretionary expenditure? Do they commit to wanting to stay in their house, or do they want to try and downsize, go cheaper, to have the level of discretionary spend that they've probably got? If they've borrowed up by upgrading their cars and having lots of holidays on loans, then they're going to be in trouble. I mean, there's no two ways about that. But if they're able to bridge their way through that, then that works not too bad. Of course, the people who are most in trouble are those people who are on minimum wage contracts or on benefits. And those people really are in the eye of a storm at the moment. And I think the gap between there's maybe 3 groups of people: the haves, who will probably be able to sail through this with some turbulence; the have-nots, who will find it really, really difficult; and those who are on state benefits will find this exceptionally traumatic. And we have to think as a society about how we help those in all probability.
Right. So yeah, it's kind of a perfect storm for everyone at this point.
Yeah.
You mentioned stress tests, and you mentioned that people were typically at they were paying 2%, but what they were really getting tested at was like closer to 6%. With the amount that they're paying, it's going up. How do you see them getting stress tests at this point? The Bank of England has removed their
+3.
3+3, yeah, but do you see that having a meaningful effect on those trying to remortgage or those trying to get onto the property ladder?
Well, because base rate hasn't shifted yet, it's still at 2.25%. The increases in standard variable rate, which is the revert to rate for most customers, or for some customers, the rest would be the revert to rate that the borrower chooses to apply, which was the rate they then have to stress on top of. That's still relatively benign, but we can expect that to increase as we go through the next 6-9 months, probably. As base rate goes up, that revert to rate, or their SVR, is liable to increase in the same way. The decision lenders then have is to how much to go over that in terms of how much they stress. Now, with the 3% taken away, the only rule that exists there is the +1% that sits within MCOBs, or what they view as the likely top point of rates. So it's something each lender can individually choose, but it must be at least 1% over the revert to rate. I expect most to work in the 1 to 2 over that range, as opposed to the +3. So the current view is that it will exclude some people from getting through the affordability sieve, but not as many people as perhaps some commentators who might be trying to spook the markets might think.
I mean, we were just talking about like a whole lot of things that is happening in the market and how they affect borrowers, but borrowers are not necessarily alone during this process. They've got a broker.
Yep.
They have a broker that can help them, really manage the home buying process to a certain extent. How important is that right now?
I genuinely think that taking advice from a properly qualified broker has never been more important than somebody in this position now. Whilst there's a lot of noise in the press about where fixed rates are and where base rate might go and what might happen to standard variable rate or revert to rates, tracker rates, which are often the unspoken thing in this market, are still relatively low. We have trackers at 3% at the moment. Now, if there's a penalty-free tracker that we can drop them because they have to transact, then as long as that's got no penalty against it, and actually we believe the administration to move them back off that can be done efficiently, then that's a really good product for people at the moment. But you're not going to find that easily on a price comparison website. So you have to know what you're looking for, because most people will just put, I want a fixed rate, into that price comparison website. A broker will take you through all of the options based on a proper structured discussion about the needs of the customer. Now, the other part of this is that that broker might be able to help you make sure that if you are getting into distress, you have the right conversation with your lender. And the lenders have been told very clearly by the Financial Conduct Authority that possession of the property is the last thing they want to happen. Right. So there's lots of options for people, which might include, for a period of time or a more extended period of time, moving to interest only. It might be a debate that says you can extend the term longer to get the costs down. Or it might be that the lender could look at you flexibly and say, well, actually, we're not going to allow blanket payment deferrals as happened during COVID, but for certain customers where they think this is the right answer, the lender might be prepared to say a 3-6 month holiday for you might be appropriate given the amount of equity you've got in your property and give you time to get yourself back on your feet. Now, that could be really helpful to some people in a time of difficulty. The thing that everyone should remember is have the conversation. Don't stick your head in the sand and avoid it, because actually, the lenders are being very strongly encouraged by their regulator to have really good conversations with customers that get the customer in the right place as opposed to the wrong place.
Yeah, I mean, this is something that we talked about with our non-executive director, Jackie Bennett. It was about like the changes that have taken place since the financial crisis and the approach that lenders take to servicing borrowers, and that's not really something that borrowers are really aware of even now.
And you know, there's all sorts of evidence that says the borrower will try to avoid because you don't want to admit you're in trouble. Actually, you fear if you tell the truth, your situation will be worse. If you think you can obfuscate a little bit, it might make things better. This is one of the situations where being brutally honest is actually the best thing to do.
Shifting back to base rates and this, very exciting topic. There's, since the fiscal event, the mini budget. I mean, there's been a lot of chaos in the swap markets. Lenders it's been increasingly tough for them to manage their product offerings, and that's led to pulled products, and that's led to brokers and lenders to a certain extent fighting like cats and dogs, in some ways. So I guess it's for me looking at this, it's how does the broker in this scenario with products kind of being put on and then taken off, depending on how violently the swap rates are changing. How do they kind of manage? Because they not only have to manage the borrower, they also have to manage the lender as well. I guess how do you see that playing out, and like what advice do you have really?
Advice is really hard in this situation because I'm not in the eye of that storm. I don't have to sit in front of customers and deal with this issue. I don't have to, or I do have to debate with lenders in terms of how they're behaving. But that's a slightly easier conversation for me to have than brokers because I'm not emotionally invested in the same way. I think the advice I can give is actually, if the broker remembers that the lender never takes the product off the shelf because they want to, it's because they have to.
Right.
For the customer, it is our job to try to work out what's best for them. Squaring those two things is exceptionally difficult at the moment. And we just have to, I think, accept that sometimes in a world, there's nothing you can do to help some people because actually at that moment in time, the right product is not there at the price that works for them. That's tough love to give somebody who's seen a house they want and thought they could afford it a few weeks ago and now suddenly can't.
Right.
The thing that we're always involved in is that when you provide a mortgage, you're providing a solution to a dream, an aspiration, something that's not just a need, it's a real emotional buy a lot of the time. And it's something that's more tangible than even buying a car or a really nice dress or a nice bit of jewellery. It's somewhere you buy a house to build a home in. And actually when somebody built a home in somewhere, keeping them in that home is really, really important. So the job of the broker, I think, is to somehow be the calm person in all of this, with all the difficulties that brings, the voice of reason, the voice of calm. And remember that actually the best way to get a lender to do something for you is to ask them nicely. The one thing that will happen if you start shouting and screaming is they will withdraw quite quickly. And it's a really hard thing sometimes to try to keep calm. But it's the one thing I think I've learned as I've got older is that whenever I've lost it with somebody, I've lost it. And I don't win the argument then.
Going back to what you were saying about, it's an emotional purchase. Sometimes it's not just about, how much of a first charge mortgage can I take out? What is my budget and like what am I looking for? It's you find a house that seemingly suits you. You want it. You can envision your future in that with your partner, with kids, or what have you. So during our when we were interviewing first time buyers, I mean that was one of the things that we found. Like of the reasons why you buy, I mean purely as an investment was like it was lower on the total. Security is what they look for. Personal security.
Yes.
So there's brokers and how they manage those two stakeholders, the borrower and the lender. But on the lender side, like how can they, if they have to take these products off, they have to. But how can they mitigate some of the the chaos that has been happening in a way?
I think it's hard for them in that traditionally many of them give undertakings that they will give at least 48 hours notice or longer to take a product off sale. For some of them at that point in time, they're almost selling tenors for a fiver because the rate that it's out there at is causing them huge difficulties. The amount of volume of business coming through the door at them means it's going to take them weeks to process it. And so it becomes a real difficulty for them, both in terms of can they afford to let it out the door at that price and can they service it within a meaningful time frame. And therefore they have to take some difficult decisions, I think. That doesn't help the broker, doesn't help the customer. But actually, when you step right back and say, well, actually, if you're at the end of the queue and you're going to get told no, because actually we've got no money left and we can't lend, but 4 weeks down the line, that's not a great place for you to be as a broker or a customer. I think the challenge, though, for lenders much more is, and maybe comes back to something we've talked about before, which is, what is the mortgage of the future? I mean, as Help to Buy perhaps walks out the door at the end of this month and we've got a period of time to complete it, and that has been a vast help in the market for many first-time buyers. How is the industry going to reinvent itself to make sure it can still service all of those customers in the same way with the right financing structures? And it's a subject close to your heart. And how do we get lenders to have more open discussions about, with not just the company you work within, but other companies as well, to see what other more flexible funding models can be put together that make it easier for the lender to stay in the market for longer at the right rate, right. And how we build all of that into better discussions and a more sustainable mortgage market. It may be a learning point out of this that says having a unitary structure where I'm the lender and I'm in total control of my own might not be the best answer. But that might force boards and risk committees to look at things in a different way now because of the challenges that have come over these last few weeks, because we should all learn from this process. Because something happens once, it doesn't mean it won't happen again, and we should all be better the next time if things do occur.
During these times of stress, that's when you learn. That's when you really get a good understanding for where the real risks are, because things evolve over time. The risks that we saw during the financial crisis they do not necessarily apply to this area. So it's new risks, and right now is a good time to kind of identify those and like you said, just think about different ways in which we could make a more sustainable housing market.
Banks are incredibly criticised, and one of my old bosses who was in charge of the UK in HSBC became the global chief exec, so Keith Whitson. Keith said, Robert, I don't get paid what I get paid for it going right. I get paid for when it all goes wrong. And I've got to pick up the pieces and make sure it gets put back together again. That's my job. Running the bank in steady state is not what I get paid for.
Yeah. Basically building off of what we were just talking about, making a more sustainable mortgage market and providing solutions so that just to make sure that the mortgage market kind of operates in the ways that we all want it to. A big player in this is the specialist lender. During this time when rates are rising and it's becoming tougher for people to get on a ladder, specialist lenders, they do provide value in more flexible criteria, more flexible view of like what kind of income that can be included. It would be great to get your thoughts on this and how what kind of role they have to play over the next really 6 months.
I think the challenge for many of those lenders who work in that part of the marketplace is their funding model, and therefore the cost of capital for them in terms of swap rates and any hedging that they might need to do in order to get the product out the door. And that therefore means that the interest rate number they're talking about is pretty lumpy in the market today. I think the challenge they all have is how they survive through this transition. And that will depend an awful lot on where they are in their securitization cycle and how full their warehouse is and what their funding lines look like. So everyone will be different. And I think that's the challenge, is that they're all different. And one of the things I don't think the industry's been very good at is being very transparent about the particular funding models of different lenders and how they operate, and therefore I don't think the broker understands that very well, either in the unitary in terms of how many of these lenders are funded, but also where they are in that particular cycle of where they are. Now, I think by the time we get to Consumer Duty being implemented fully next July, that might have to be something that has to be more transparent, so that brokers can make decisions about where they place lending. So I think there'll be a big push-pull about this, what the funding model looks like in relation to all of that.
Because sometimes they just look at the price, the end price that is up there, and it's just like, is this really fair? But you have to understand what they're dealing with, because they have to protect their commercial interests a certain way, to a certain extent. Yeah.
And the other part of this is a really interesting one, is that I've been on the board of a building society previously and just joined the board of another one. One of the biggest challenges you have is that we've been through a benign arrears and repossessions environment for so long the ability to actually generate provisioning through a world where we've not had the losses on properties because of house price inflation for so long means that you can be staring into a downturn but not able to make any provisioning for it, or make it very hard to make meaningful provisioning because of the accounting rules. So you get all sorts of stuff around the edges of this where you're having to factor and think about things in a way that the rules almost make it harder to work. But the importance of these lenders to the marketplace where people can have payment blips or are trying to fund on it unusual properties is really, really important. And particularly lenders where an area close to my heart is the self-build arena, where we really need to help and support people building different styles of properties other than just the David Wilson's homes on standard estates, which are really nice, but not very interesting.
Yeah.
And so we need to have a diverse culture of housing in the UK because we have a diverse population, and therefore we should have a variated set of lenders that support and can underpin all of that can deal with the vagaries of the way we all live our lives differently, because there are lots of people with lots of jobs and lots of different income streams that don't drop into the mainstream banks' affordability models, and they need a lender who look at them as individuals, not as a credit score commodity.
Right.
And therefore it's really important we have this in the UK, in my view, because I wouldn't want to become that homogenised world where you're only dependent on your credit score to get the mortgage, because that isn't the right place to be.
Yeah. We don't want to box people into a more corporate job.
I'd rather not.
Let them be them.
One of the big issues at the moment, of course, is buy-to-let. I mean, buy-to-let, if you're in that line south of Bristol to Hull, the rental yields you are now getting versus the cost of borrowing and the stress tests that are being applied make that a really difficult market. And we will be talking in the next few weeks to the Bank of England, the PRA, about some of the controls that are currently in that marketplace in terms of stresses. Because I think unless they come up with some different rules, we're going to see some challenging problems for people coming off rates in terms of how that will operate.
In the buy-to-let market.
Buy-to-let market particularly, yeah.
Yeah, I mean, that's kind of... it's somewhat forgotten, but it does have an interplay within the residential market as well. If we see interest rates going up, which for buy-to-let mortgages, which obviously affects rents, which affects people's ability to save, can they get a deposit? And
it's exactly the same issue. And so the total cost of servicing mortgage debt in its widest sense in the UK is an issue, and it's why it's an important part of how the Bank of England looks at financial stability, because they know that the cost of servicing, the amount of debt there is against UK residential property, is a key part of how much money people have got left to spend on the high street. And that balance has to be kept in a reasonable kilter, otherwise you end up with an awful lot of retail closing, and retail is an important core element of the UK economy.
One of the things that kind of, as we've been building OnLadder over the past 2 years, is just how important housing is to everything. It's not even just first-time buyers, although that's our main focus. It's everything kind of interplays and affects something else, whether it's within housing or outside housing.
I mean, there's some interesting graphs that correlate house prices with consumer confidence. And it's very hard to work out, even from a economics perspective, which one dictates the other. Does consumer confidence drive house prices, or does house prices drive consumer confidence? The two are inextricably interlinked. That's all you can say. And I think they drive each other almost equally, and therefore you get some interesting... You can't differentiate and say one will lead the other. They're just the same.
Right.
And the UK psyche drives it that way.
We've talked a lot about the swap rates and everything like that, but how do you really see them performing over the next 6 to 12 months, let's say? Obviously, there's the base rate from the Bank of England, and there's the swap markets.
Yeah.
But those don't necessarily move in tandem at all.
The disconnect between base rate and swaps has been really evident since before the financial crisis in 2006. And what we have seen across the global economy is that, whether in Europe or America or the UK, the amount of money that has been flooded into the world economies by quantitative easing in various forms has meant that there's been cheap money around the world chasing a return. There is still an excess of that money around out there chasing a return. All that has happened here is that fears over, effectively, government's ability to service its debt has driven gilt rates up, which has therefore forced swap rates to move to cover that gap. So there's some really interesting connects and disconnects around all of that. And it's that fear of things going wrong that has driven those rates up. If genuinely the US economy under Biden can come back under control. Inflation comes back under. It's inflation that's driving this fear. When you have inflation running at 10% and rates are at effectively 4, 5, 6%, that's negative return of 5, 6%. Now, the UK has been running at a negative return on gilts, on return on most things for about minus 1.5 for the last 8 years, which is unnerving. But it's driven a lot of the activity that's gone on. So this real rate of return is what people are looking for around the world if you're an asset holder. And this has driven rates up. Do I think that will bed back down? It's wholly dependent on inflation coming back out of the major economies, whether that's Europe, America, the UK, or even Japan, China. If that happens, then rates will settle back down. If that doesn't get squeezed out, then it becomes really difficult. But it's hard to see where, oil price has gone up to 120 a barrel, back to $90 a barrel. Well, it's been as low as 85 recently, but it's back at $92 this morning. You can see the price of effectively forward price on gas has oscillated between £2 and £6 a therm over the last 6 months, settling in about, it's been as low as £2.20 in the last week and back up to £3.40 again today. That volatility is still causing angst in the marketplace because people don't have certainty. People can't see what the cost of giving the subsidies out there to government is going to be. That uncertainty means gilt returns and swap rates will continue to be volatile for that period. And it's those things that are driving the uncertainty. If inflation comes out and we can see more certainty about asset pricing effectively, then you get to a more stable place. Anybody who says it can predict more than 12 months ahead, I would label a fool. Because I don't know anybody who could really think more than 12 months ahead with any degree of knowledge or certainty. And being old and with grey hair, whenever I've tried to predict more than 12 months ahead, I've normally made a mistake, not just in my day job, but also in my personal life. Anybody who thinks you can predict what's happening in your family more than 12 months ahead starts staring bonkers.
So this is probably a perfect time to ask the last question, which is, we've talked about the next 12 months. What happens after that? It would be interesting to get your thoughts on just how things progress from here, moving from a cheap capital, a very highly liquid economy to maybe something a little bit less than that.
Andrew Bailey and the Bank of England already said they wanted to try to remove some of the quantitative easing that had gone in. And then we had a government that wanted to throw money at the wall and dash for growth. And the two things just go like that. Bonkers that anybody could think that would work. What I think you have to look at is that as a world, and particularly as Western economies, we have an unerring ability to fix things in time. You look back at all the previous crises, whether it's oil price shocks way back in the 80s, you look at the big crash of the 90s, you look at where we were in 7-8, we fix it. And therefore, there may be some corrections in terms of asset prices. We might see property prices come off by 10%, 15%. Is that a bad thing? It's only the 20% we've put on in the last 2 years. People should not be as emotional about it as the commentators might want us to be. And the worst thing you can do is talk yourself into trouble. And as long as we keep level heads, keep sane, look at what we're doing, and are sensible, we will find a way through all of this. Because if we don't, the alternative isn't very pretty. We are people who actually, we're a society that always pulls together and actually ends up wanting to help each other. And that is what society is all about. We will find a way to make this better. The challenge is just always how long it takes. And therefore, I'm always positive about the future because I fundamentally believe that the human race works well together, and therefore we'll find a way to make it better.
Positivity.
Yeah.
That's something we've seen a lot over the past 4 weeks, but it's good to end on that note. Robert, thank you very much for coming by.
Good to see you. Thank you.